Tom Braegelmann here to talk about mezzanine financing. We have an example project here. It's a multifamily set of complexes in the Tucson area. Give you a quick description of the property. There are a total of 1,004 units, all Class B type properties. Pretty good shape overall, good areas. They were built between 1973 and 1985. The purchase price for these, for all of the buildings combined, came to $45,500,000. The cap rate at the time of purchase was purchased basically at 6.6% cap, and the net operating income at that point was $3.01 million. So the net operating income is just the number. It's the net income after expenses are taken out. And the way to calculate the cap rate, as most of you know, is the net operating income divided by the purchase price. So that came to 6.6%. Conservatively figuring year one net operating income after some improvements are done would be at $3.24 million. The debt coverage ratio, or the debt service coverage ratio, generally referred to as the DCR, was at 1.89. Pretty good number. The debt coverage ratio is really just taking the net operating income, dividing it by the debt service on the project. The project has strong stabilized income stream, but it did have some opportunity to increase value. The rents were about $10 below market, and just for point of reference, a $10 increase per door per month in this project would realistically bring about $1.5 million added value to the project. The improvements that are needed came to about $4,000 per unit. That would include taking care of the kitchens, bathrooms, floor covering, and some of the commons areas. That $4,000 per unit would represent about a $75 per month per door increase, so that could total about a $13.5 million increase of the project. Demographics, the area is good, near plenty of employment, good roadways, thoroughfares. The Tucson area is good and solid. It's expanding, 20,000 residents per year estimated over the next decade. And then the projected job growth is also strong at 2.4%. So looking at the numbers, we have $47.5 million in purchase price. It's going to take about just over $7 million to do the construction. That includes construction costs, interest reserves, other reserves, and closing costs. So taking the $47.5 million and the $7,010,000 gives us a total cost for the project of $54,510,000. Now, to get that funded, the way it's structured is a $38 million first position. That represents 75% loan to cost. So 75% of the capital being brought in is done by the conventional financing at about 3.75, just under 4% interest rate. The equity investor coming in, they are coming in with 90% of the equity required. They're going to get 90% ownership of the property. They're asking our borrowers to come in with 10%, or that's the way it's structured, is for the borrowers to come in with 10%. So the $14,710,000 would be brought in by the equity investor, and $1.8 million would be brought in by our borrowers for an equity piece of 10% in that project. That total then brings us to the total capital needed, which is $54,510,000. The estimated value after 12 months, once most of the improvements are done, would be $56,730,000, and estimated after 5 years, which this is set to be a 5-year play, is projected at almost $65 million, $64,799,000. So if we put that into charts, we show the purchase price of $47,500,000. Putting in another just over $7 million, it brings it to $54,510,000. After the first year, it's $56,730,000, and then after the 5-year point, it's estimated to be $64,799,000. If we look at the capital stack, the first position coming in with 75% of the capital needed is $38 million. The remaining 25% is brought in by 90% by the equity investor and 10% by the equity partners or our borrowers, which is the mezzanine financing. That number is $1.8 million. If we look at the equity piece on it, the equity owner is 90% of that top square, and the equity partners is 10%, but if we go the first year, it also follows the same, and years 2 through 5. So this just shows how the equity is split as the property increases in value, 90-10 all the way through. So I'll tell you why we like the project. It came from a good, one of our best borrowers, repeat borrower. We've done joint venture projects with him. He's got a very sophisticated team, full C-level team with all the capabilities of running projects across the country. They have a track record of doing successful projects over quite a few years. They also brought all the participants. They had the participants in place, ready to go. They had the first position lender. They had the equity, 90% equity investor. They had the project. All of that was put in place, brought to the table. The project already had good numbers. It had room for improvement, but it had the good cash flow and minimal disruption by the amount of work that needed to be done. Not a major rehab, just more of a little bit more than a cosmetic rehab. And we liked it because it could be replicated with this structure, especially the way we have it structured now. We have the ability to do plenty more projects after this. So what are the potential risks? Had a bit of a challenge coming up with a whole lot of risks, but probably the biggest one would be the large first position. But even that, it has the cash flow for the project to cover the full capital stack, the full debt service, and the potential for increasing improving the project also allows for improved cash flow. So we didn't feel like it was a major risk, but the project does have 12 months of interest reserves for a portion of that monthly payment. I'll show you that in just a few minutes. So other than that, we weren't able to come up with a whole lot of bigger risks in this project. So again, what the borrower brings to the table, they brought the development project, they brought the first position lender, they brought the 90% equity participant, they brought the sophisticated team and the experience. The borrower is also a high net worth individual. His net worth shows at right around $90 million, and he has some substantial cross collateral or collateral property that we were able to use as cross, and we'll show you that in a minute. So the deal structure they suggested for us was a 90-10. Let's see. No, this is a deal structure that they worked out with the investors, with the equity investors. 90-10 split. They get 10%, the equity investors get 90%. They come in with 10% of the cash. The investors come in with 90% of the cash. It was done by way of a single purpose entity that the 90-10 ownership was built into, but the 10% was brought in with another single purpose entity of which we actually become part of that 10% equity piece as collateral. So the investors, the 90% equity investors, they get 10% return on their investment, on their cash investment, preferred, but it's also a cap. And so the sponsor manager or our borrower, they are able to keep anything over the 10% interest potential as basically the override, plus they keep 10% equity in the project. They also negotiated a 1% acquisition fee, which in this case is about $550,000. They have a 4% property management fee. They have a full team that manages properties across the country. The operating reserves, this is what I mentioned earlier. There are reserves in place to cover any operating expenses should the occupancy go down to as low as 80%, and that would be enough to cover it for a year. So certainly not anticipated, but it's just a precaution. And like most other mezz financing or mezzanine financing, there are no liens allowed against the property, but there is a lien against the entity that owns the property. So the borrower's proposed structure to us was to bring in $1.8 million. We would have a 5-year play on it, get the loan paid back in 5 years with 10% interest on it. We would get 20% ownership of the sponsor manager entity, and we could use the ownership entity as collateral for our loan. And in this case, the equity after the first year in the project, once the improvements are done, we came in at about 84.5% loan to value, which in a property like this is pretty good, pretty substantial, considering it's a operating cash flowing property. So what do most all sophisticated investors look for? What is their goal? They like to increase the returns and reduce the risk. So we looked at that and we decided on a couple things. We shortened the term of the loan and we reduced the loan to value. So I'll show you how we did that, but those were two things that we felt could make the project more profitable and even less risky. So we have it's structured in a way that the sponsor manager entity is used as collateral. We also have substantial cross-collateral property that we built into the equation. And with that cross-collateral, there's actually a predetermined early exit because that property has purchase contracts on it for it to close within the third or fourth quarter of this year. And we included a personal guarantee by the borrower who has the substantial net worth. By doing this, we changed from an 84.5% loan to value. We actually have it to a 27% loan to equity. And I'll show you what I mean by that here in a second. Loan to equity calculation. If we take the $44.2 million of equity in the subject property, which is what's there after the improvements are done the first year, and we take the cross-collateral value, which in this case was $2.55 million, that is total equity of $6,750,000. We take the $6,750,000 divided by 1.8 million, which is the loan amount, and that's how we arrived at the 27% loan to equity calculation. Just to give a graph on that, or a graphic, we have $54,510,000 as the cash in. There's equity of $4.2 million on top of that. The note is collateralized by that $4.2 million, plus it's also collateralized by the equity in the cross-collateral. So that's how we got the total numbers and got to the 27% loan to equity. So the final structure, it was set up that we were able to increase returns and reduce risk by changing it from a 5-year loan to a 12-month loan. The borrower at the end of, or actually before the end of 12 months, is going to buy the note with the sales proceeds of the cross-collateral property. That's part of the contract. And the borrower then would also receive 10% interest on the note. So he's getting a return on that money, just like we would have gotten if we had kept that risk capital in for the full term. We got paid, in this scenario, we get paid back after 12 months or a bit earlier, but we retain what would be the same as 3% interest on what the original note amount was. So 3% interest on $1.8 million for the remaining years 2 through 5. And that 3% would continue to come without any risk capital even in the project anymore. Plus, we would retain equity participation of 20% ownership of the sponsor manager entity. So years 2 through 5, the property appreciates over and above what it was when it was purchased. That appreciation, that equity is all building as time goes, but without any risk capital into the project whatsoever. So here's the structure for our investors. This is the last slide. The way we set it up is $1.8 million loan for 12 months. And the first year, the investors get 10% interest on $1.8 million is $180,000. Years 2 through 5, if we take, in this case, our investors are set to get 1.5% of the cash flow. So that would be $27,000 per year for years 2 through 5, which brings, and then the year 5, there's the equity kicker, which we believe is conservative at $443,705 for a total of about $614,000 after 5 years of ownership with risk capital only being in for the first year. And with that, we reduced the risk, what we feel is substantially, and we increased the ROI from what was projected at 15% to a projected 34% just by using this strategy. Hopefully this was helpful, and that's it for now. Thank you.